Okay, Lama, I think I'm audible to you all, right? Am I audible? Can you drop me a message to the chat? Yes, right. Okay. So, guys, welcome to the model paper discussion on AAT 3, right? So, today we'll be discussing financial reporting and governance model paper, which is prepared. And basically, I prepared this paper analyzing the past papers and what is the trend, that what area going to be tested, and overall, uh, after analyzing everything, we have prepared the paper. So I believe that the questions we have covered here, more or less, it will be tested in your exam. Even the last time when we did the model paper discussion, from the paper, if I'm not mistaken, more than 90% of the paper we were able to guess, right? So that the same benefit you are getting from this year as well. And let me thank JMC Virtual Learning team because they are the ones who initiated this project. So you know JMC Virtual Learning, it's the premium learning platform for the professional students in AAT Chartered CMA Banking. So you all can purchase JMC learning packages and watch again and again and again to get through the exam and get the support of our professional lecturers. So I'm lecturing for the financial reporting and governance, financial accounting and reporting subject. And so that even if you are pacing for the exam in the next month, if you are still there are a lot of areas to be studied, then better to take e-learning option, e-learning packages. And not only that, even after you have completed your AAT 3, going forward with chartered accountancy, definitely you all can go ahead with vLearning packages, recorded video packages provided by JMC Virtual Learning Unit, right? Okay, so let's move on to the paper. Lamai, you'll know that in your paper, you will get 15 minutes of reading time and 3 hours for you to do the exam paper. And you need to answer all the questions. There's nothing you can actually ignore. All the questions you have to attempt. And you can use the calculators and you have to focus on the action verbs. That is the most critical thing. Depending on the action verb, you need to answer. Okay, right. In the meantime, there are a few students in the waiting room. I think our staff members will take care of that. Right. So let me do it in such a way. I mean, now I have created the paper and I hope you all already had the paper and you all have gone through the paper. What we need to understand is what we are doing is a 2-hour session, so we may not be able to do all the questions. Right? Because 2 hours will not be enough to do the entire paper. So what we can do is, if you all have any preferred area to be covered, preferred questions to be covered, you all can ask them through the WhatsApp group, through the chat, so this question to be covered like that, so that we can do it accordingly. තේරෙනවද? ඔයාලට මේ පේපර් එකේ මෙන්න මේ ප්‍රශ්න ටික කරමු කියලා හිතෙන ඒරියාස් තියෙනවා නම් ටක් ගාලා කියන්න. එතකොට මට ඒ ටිකෙන් යන්න පුළුවන් ඔයාලට නිකන්. මේ ප්‍රශ්නේ ටිකක් අමාරුයි වගේ, මේ ඒරියා එක අමාරුයි වගේ කියලා හිතන තැන් තියෙනවා නම් කියන්න. right? එහෙම තියෙනවා නම් මට chat එකට දාන්න so that I can start from those questions no. right? මෙන්න මේ question එක කරා නම් හොඳයි, මෙන්න මේක right quickly. ටගද? chat එකට. right. So what I asked was, if there are any difficult questions you need to attempt first, right? If there are any difficult areas, please do put them in the chat so that I can start with those questions, right? So one student has responded saying the company question. Who else? What else? What are the other questions that you'll need to attempt quickly, Lamai, so that we can, for an example, maybe you want me to do the deferred tax question. You want me to do the maybe a different question, right? Maybe the borrowing cost, right? So we got one student saying, can you do the console question? One student has asked, can you do the console question? Good, right? Yeah, the consolidated question. Okay, no worries. Good, 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 good. Okay, right. So what we will do is, as per your request, we will start. Few students have requested to do the company, the cash flow, and like that. So accordingly, based on your request, we'll decide. Right. So let me, start with the one of the easy questions, the cash flow. Right? It's easy, but if you know the real method, then much easier for you to tackle. Right? Someone is asking to raise the sound. I don't know. I'm talking in my maximum sounds. Do I need to do something on that? I mean, Anika, others, you all can hear, right? I think it should be okay. Others, you all are okay with the sounds? It should be okay. Yeah, I'm audible. Right. Okay. Lamai, let's work on this question, the cash flow. Right. So around 4 to 5 students have asked about the cash flow. Let's work on the cash flow question first. Right. Okay. Now look here. In your paper, you will have to start with the requirement. Right. Let me read the requirement and you will have to highlight. You are supposed to prepare the cash flow statement using the indirect method. Okay. We'll start from the beginning. Statement of financial position of Ayana Private Limited is given to you. You have PP depreciation, inventory cash flow, stable retained earnings, long-term loan, employee benefits, this and that are there. I will look at the additional information given. The tax expense was estimated as 105. Okay. A machinery was disposed on 1st of April. The cost and the accumulated depreciation were 5.1 million and 2.5 million. A loss of 750,000 was incurred on the disposal of the machinery. A new machinery was purchased to replace the disposed machinery. There's nothing else. Gratuity paid was 360. The gratuity when an long employees resigning from the job, you have to pay a compensation. That is what you call the gratuity. Interest on loans for 50. A loan of rupees 2,000 was obtained during the year. No dividends. Good. Right? Okay, guys. So these are the areas, when you're tackling a question, look at the requirement, then go through the question. Then you have to draft the format. Right? Let me use an Excel for this. Then it'll be much easier. So we are doing question number 5. Ne? Question number 5. Question number 5. So this is Ayana Limited statement of cash flows for the year ended 31st March 2024, rupees in thousands. We need to start with the operating activities. We are going to start with the profit before tax. For that, you are going to do the adjustments. Right, then we'll keep some space for the adjustments. Then we will have the working capital changes. Keep some room for working capital changes. Then we are going to deduct the tax paid. We are going to deduct the interest paid. We are going to deduct the gratuity paid. Thus, we will get the net cash flow from used in operating activities. Then we have the investment activities, investing activities. We'll keep some lines. Give the net cash flow from the investing activities. Then you'll have the financing activities. Net cash flow from the financing activities. Then we have the net cash flow so that we'll add the opening cash and cash equivalents. We get the closing cash and cash equivalents, right? Okay, so the format is something like this. Right. Here's the size of it. This is the cash flow format. You'll know that, right? Cash flow format is one of the easiest formats. You can easily remember. Once you're done with the format, just drop me a message so that I can start the question. Right? Now in the question, you are getting console question, you are getting company question, you are getting cash flow question, right? So like that, there are some standard questions, deferred tax. So just have a small piece of paper and put down all the formats into that paper, right? So that you can easily, even whenever you are going to the exam in the morning, even you can just look at that paper where you have all the formats together, right? The success rate of the exam depends on how fast you are drafting the formats, huh? Right, good. Right. Few students are there in the waiting room. Please check on that. Right, good. Structure is drawn. I think everyone has done with the structure. We can start doing the question paper. You can start with the workings. Let me do the workings here. Right. Now, for me to do this working, I may need several T accounts. So let me work on some T accounts. I'll just drop some T accounts because I may need some T accounts. Okay, that's it. Right, so let's start doing the question paper. Right. We need to start with the additional information given, right? Now, the first additional information is the tax. Now, whenever you see an additional information, you need to understand what are the relevant T accounts, what are the relevant financial position items. Okay, when it comes to tax lamai, the two items would be one is one side the tax expense ultimately get parked in the retained earnings. The other one is the tax payable. Ne? So the relevant two accounts will be one is retained earnings because that is where you park the tax expense ultimately, and the tax payable. So let's draft the two accounts. Ne? Accounts like draft karum. One thing is I need the retained earnings. Other one is I need the tax payable. Then put the opening and closing balances. Retained earnings, we got 2187,350. 2187, which is opening balance. and the closing balance is 3050. Tax payable, the opening balance is 763, but the closing balance is 150. Right? Okay. What I did was, now I'm supposed to pass the entry for the tax expense. I just open up the relevant accounts. One is the tax expense, which is getting ultimately parked in the retained earnings. Second one is the tax payable, right? You don't have to write the double entries, but for your information only, I'll just write them. So when it comes to a tax expense, you know the double entry debited to tax expense, which ultimately gets parked in the retained earnings and credited to tax payable. So we are going to replicate that transaction. Yeah. So as per the question, the tax expense is 105. No? So debited to tax expense, so which will get parked in retained earnings and credited to tax payable. Let me put it here, the tax expense. Right. Okay. So you just have to do, what you need to do is open up the relevant T accounts, then just pass a double entry. So that's it, right? Don't try to close the T account. We'll just keep it as open. I will move on to the second working. Second working is about a machinery that has been disposed. So what are the relevant T accounts here? When it comes to machinery disposed, obviously the PP and the accumulated depreciation, plus there will be a disposal gain or loss. So let me open up those T accounts. One is the property, plant and equipment account. Other one is the accumulated depreciation account. Plus, I may need the disposal gain or loss account. Right. So let me put the opening and the closing balances. Opening balance is 8,200 and the closing balance is 10,500. Let me put the opening and the closing balances here. In the accumulated depreciation, the opening balance is 4,800. Closing balance is 5,600. So we just opened up two T accounts and we put the opening and the closing balances, right? Then what we need to do is, we need to pass the double entries. That's it. It's very easy. Now look at the double entries here. Machinery was disposed. The cost of the disposed asset is 5,100. Accumulated depreciation is 2,500. Now, cost of the disposed asset is 5,100. What is the adjustment required? The cost of the disposed asset we need to remove, right? We need to remove that from the PP. So we are going to remove that 5,100 from the PP and we are going to recognize in the disposal gain or loss. Let me put that as PPE. Here, disposal gain or loss. So debited to disposal gain or loss, credited to PPE. Then the accumulated depreciation is 2,500. So we are going to remove that accumulated depreciation from the accumulated depreciation account, debited to accumulated depreciation, credited to disposal gain or loss. So we just change the name, accumulated depreciation, and here disposal gain or loss. Right. So the cost of the asset was transferred from the PP to disposal. Accumulated depreciation was transferred from depreciation account to the disposal gain or loss. Then what else they say? They're saying there's a loss of 750 incurred on because of the disposal. Then what is the double entry for the disposal loss? So my disposal loss will be recognized in the profit or loss, right? Disposal loss will be debited to profit or loss. That will be recognized under another expense. Credited to disposal gain or loss. So credited to disposal gain or loss, because we are transferring that to the profit or loss. Debited to P&L. Now it is being reduced, it is being deducted in the profit before tax. If you take this profit before tax here, in the profit before tax, the disposal loss 750 is already deducted, but it's not a cash expense. It's not relevant to operating. Then I have to remove that. Neither. So I'll be adding back the disposal loss. I have to add back the disposal loss. right? I have to add back the disposal loss. Clear? Right. So we remove the cost of the asset, we remove the accumulated depreciation. The disposal loss, it's already been debited to P&L, we have to remove that. Right. So that is why we added. Because already deducted item, so I added. And on the other side, I credited that to the disposal gain or loss. So that's it. That's the adjustment. Okay. Right. So don't try to close any T account. We'll do that as our final thing. Right? Right. Next one is a gratuity paid during the year was 360. Gratuity paid during the year was 360. So the gratuity, what is the relevant item? Gratuity provision. Right? Let's open up the gratuity provision account. We have the opening balance, which is 1,200. And we have the closing balance, which is 1,600. Someone has asked, can you share the paper here? Right, I shared that in the WhatsApp group. No? Let me see, is there a possibility to share? But should be available, right? Okay, so what I have done is now the gratuity liability opening and closing balances were recorded in my T account. Then they're saying gratuity paid during the year was 360. Gratuity paid during the year was 360. What is the double entry for a gratuity paid? When you're paying the gratuity, cash comes down, credited to cash, debited to gratuity provision, right? Debited to gratuity provision. So credited to cash, debited to gratuity provision, 360 as cash. And you're paying that, right? So we have to deduct that from here where we record the gratuity payment, which is 360. Clear? Gratuity paid. Okay. Yeah. Look at the next item. The next item is interest on loans. Interest on loans for the year is 450 and the loan balance was 2000 obtained. So we need to open up two T accounts. One is the loan account, other one is the interest payable. So let me open up. One is the loan account, other one is the interest payable. We need to put the opening and closing balances. Right, Lamai, when you are taking the loan balance, take the long-term and the short-term loans together. So 2,750. I'm taking 2,700 plus 50, both loans together, short-term and long-term. Then long-term loan 3,300 and 150. 3,300 plus 150. So the logic here is most of the time, Lamai, from your loan, the current portion will become the short-term loan. That will be recognized in the short-term loan. So we just take them together. That will make our life easier. Then the interest payable. Let's take the interest payable. Interest payable is 70 and 100. 70 and 100. 70 and 100. Okay, right. Let's see this one. Okay, the next item, they're saying interest on the loans for the year was 450, loan of 2000 obtained. We'll try to pass a double entry. When it comes to the interest expense, what is the double entry? Debited to interest expense, credited to interest payable. Credited to interest payable, 450. Interest on loans was 450. Then the interest expense will be debited to the P&L. Interest expense will be deducted under the finance expense. So at the profit before tax, it's already been deducted, but it's not the exact amount we paid in cash. So interest expense was deducted here, but we need is the interest paid amount. So in order to deduct the real payment, Lamai, we need to remove that expense. Expense is not what we paid, no. So we are going to remove that expense. So plus interest expense, which is 450. Okay. 450, we added the interest expense. Why are we adding that? Because at the profit before tax, it's been deducted. So to remove that, to net it off. Okay. Right. Then they're saying they have obtained a new loan. What is the double entry for when you're obtaining a new loan? Debited to cash, credited to loan. Debited to cash, credited to loan. So it's cash. We need to update in the cash flow statement. So we put that as a loan obtained. Right. Okay. So done. We have taken all the adjustment into the T accounts. Then we need to, there's nothing for the fifth adjustment. Then we need to go through the financial position for any other item which we haven't taken care of. We are doing the question number 5, cash flow. Right, now look here, the inventory has increased. What is the cash flow implication? Inventory is increasing because you are purchasing inventory. So my cash is coming down. So let's look at, put that into the working capital changes. Increase in inventory, right? Increase in inventory is a cash flow reduction. So how much is increased? 6,080 minus 5,580. So it's when the inventory is increasing, my cash flow comes down. Then trade receivable has decreased. What does it mean? Yeah, trade receivable has decreased. What does it mean? When my debtors are coming down, I'm getting money. Debtors are coming down because they settle. Decrease in trade receivables. 1920 minus 2330. Right. Inventory increase, my cash flow comes down. Debtors comes down, but I'm getting cash. Okay. Right. Then the opening cash balance is 990, closing cash balance is 1200. We'll update that as well. This is my opening cash and cash equivalent here. Opening cash and cash equivalent 990, closing cash equivalent is 1200. Okay. That's update correct. Stated capital does not change. Retained earnings we took, long-term loans took, gratuity took, trade payables has increased. When payables are increasing, that means you are not paying them. So you're keeping money with you. That's a cash kind of an inflow. Inflow, impact neither. Right. So then we'll take that as increase in trade payables. When the payables is increasing, you are keeping cash with you, so which is a benefit. Right. Okay. So we have taken care of all the items in the cash flow statement. Now we just have to close our T accounts. Just have to close our T accounts. So once we close down the interest payable account, we'll get the interest paid in cash. How much is that? So the interest paid in cash is 420. Interest paid minus 420. Then let's look at how much of loan being paid. Loan being paid. 2750 plus 2000 minus 3450. 1300 worth of loan being paid. So we can put that under the loan payment. 1300. Okay. Right. Let's look at how much is the gratuity expense. You can calculate the gratuity expense. So gratuity expense is 760. I mean, when it comes to the gratuity expense, what we need to understand is that is already been deducted at profit before tax. It's been deducted, but it's not a cash expense. From the cash you have paid 360 only. So the expense is already deducted. We need to remove that. So we are going to remove that by 15 plus gratuity expense. Let's look at the disposal proceed. How much will be the disposal proceed? From the vehicle machine to disposal, I'm getting 1850 cash. Machinery disposal proceed, I'm getting 1850. Let's look at the depreciation for the year. $3,300. Depreciation is a non-cash expense which is already been deducted in the profit or loss. Depreciation is something already been deducted, so I need to add that back. Let's look at how much of PP recently. Yes. How much of PP being purchased during the year? You have purchased PP to the value of 7,400. You have purchased PP to the value of 7,400. $7,400 worth of PPV has been purchased. Right? Here we have put the PP purchase 7,400. Let's look at the tax payment. How much? How much of tax being paid? 718. Tax payment 718. Right. Finally, you can calculate the profit before tax. Right? From the retained earnings, the balancing figure what you're getting is the profit before tax because tax is being added. No? So you can calculate the profit before tax very easily. $968. Okay. So which paper you are doing? I'm doing the model paper which I gave. I shared this in the WhatsApp group and just now I shared that to the chat as well. Chat then share karan. I'm doing the question number 5 cash flow. Okay. You didn't get. So can you send this Excel work after this question? Generally, I'm not recommending you to do that, but I want you to attempt, right? I want you to do the question along with me. Once you send your answers, I'll send the Excel. I'm in the WhatsApp group. Otherwise, don't depend on the entirely on the answers. You work by your own. Then if somebody requests after doing your work, then I'll send. It is workable. Okay, right. So So where does the balance of the loan account goes? So the loan account goes to the short-term loan I included in the loan balance itself here. Short-term, long-term both, right? Okay, we are done with the question. Now we can just get the final answer. So we'll just add them together here. 6558. So with all the cash flows in, so net cash flows from operating activities is going to be 5060. The net cash flows in net cash flows used in investing activities is 550, and the net cash flows from the financing activities is going to be 700. Right. So the net cash flow as a result of all the three activities is going to be 210. So 210 plus 990, you'll be getting 1,200. Right? Okay. So no worries, we have done. You can get, I think, if you have purchased the vLearning packages, this recording will be updated to your vLearning packages as well. I don't know, you have to check with the vLearning team. Huh? Right. So we are done with the cash flow question. Question gets tallied at 210. Clear? Somebody wants, let me reduce the size of it to get a full idea of the question, something like this. I don't know if it's visible for you. Okay. Right. So can you please do a console income statement sum? Right. Good. We'll do that. Show me the retained earnings, someone is asking. Right. Okay. Yeah. From the retained earnings account, you get the profit before tax. Huh? Right. Okay. Done. Right. Lamai, that is question number 5. As per the request, I'm moving on to another question because our time is also passing on. Good. Okay. Right. Let's move on to the paper. Now, as per the requests I'm getting, let me move on to the console question then. Huh? See. Question number 9. Okay. Right. So let's do the consolidation question. Right. Okay. First of all, you are required to calculate the goodwill. Prepare the consolidated income statement. Okay. 1st April 2023, Sigma acquired 75% of Beta. Beta's rupees 1 million, Beta's 1 million ordinary shares for 290 million. On the date of acquisition, the fair value of the identifiable net assets of Beta was 340 million. The market value of a share as at 1st April 2023 was 365. Comprehensive income statement were given to you. You got sales, cost of sales. You have different other income, interest income, dividend income, other income, distribution, administration, finance, PBT, tax, profit for the year, 0 other comprehensive income. Additional information. During the year, Sigma right? In this question, my Sigma is acquiring Beta. Sigma is the parent company. Sigma has sold goods costing 5 million to Beta. Goods costing 5 million to Beta with a profit margin of 10% on cost. As at 31st of March 2024, the closing inventory of Beta PLC include 1.1 million worth of goods purchased from Sigma. 2 years ago, Beta invested in 5 million debentures issued by Sigma, which will be matured in 5 years. Interest rate is 10%. Interest income of Beta is included in the interest received. Sigma PLC has occupied the stores belong to Beta from 1st of April. Annual rent is 50. 1st April 2023, Beta sold a machine to Sigma for rupees 5 million. The machine had a carrying value of rupees 4 million. The useful life of the machine was 10 years. Right. So these are the information given. The next step is to draft the statements. Let's draft the statements. Draft the consolidated P&L. So this is Sigma PLC, Sigma Group, consolidated income statement for the year ended 31st March 2024, rupees thousands. You have the sales. From that you need to deduct the cost of sales. You'll be getting gross profit. You have some other income. Particularly the sources of other income include interest income, dividend income, and other income. Then we have the expenses, the distribution expenses, administration expenses, and the finance expenses. Then we got the profit before tax. We have the taxation. We have the profit after tax. And we need to show the profit after tax, or I'll say PAT, attributable to parent shareholders, and PAT attributable to NCI. Then you have the other comprehensive income and total comprehensive income. We'll have the same thing. We have to separate as TCI, attributable to parent shareholders, TCI, attributable to NCI. Okay. So we have prepared the format. If you are ready with the format, just let me know so that we can start. The format is pretty easy. You have to take the exact format given in the question. Only thing is, after profit after tax, you need to have a small presentation that the profit after tax attributable to parent shareholders and the NCA. Same thing for the TCI, total comprehensive income. That's it. Nothing major. Okay, right. So we'll start. The first one, what they are asking is for you to write. The first requirement is to calculate the goodwill. No, Lama? Let's first work on that. Huh? So part A, they are asking you to calculate the goodwill. Okay. Right. Goodwill calculation is pretty easy. The goodwill calculation is you just take the consideration of the parent. Right. To that you add the non-controlling interest. NCI at acquisition. From that you need to deduct the fair value of net assets of subsidiary. That's it. Fair value of net assets of subsidiary. So kind of very easy adjustment. Right. We'll take the consideration of the parents. Parents' consideration is the amount agreed. No, the parents acquired 75% for 290 million. So that's 290,000. Then the NCI, you have to calculate the NCI, right? You need to calculate the NCI. Let's do a working NCI at fair value. Now, if the question is giving you the market price of a share, apply the NCI at fair value. NCI, there are two methods of proportionate share of net assets, NCI at fair value. When the examiner is giving you the market price of the subsidiary at acquisition, that indicates you need to use the fair value. So we'll take the number of NCI shares. How to get that? There was 1 million shares. Let me take that as 1000 into 25%. Okay? Why NCI percentage is 25%. There was 1 million shares. Okay? As per the question, there was 1 million shares here. Of that, 75% belong to Sigma. Balance belong to the non-controlling interest. Then the subsidiaries market price per share at acquisition. That is also given to us. 365. So we'll take the NCI balance then. 91,250. Right, we got that done. 91,250. Then the fair value of net assets, we just have to deduct now. That's 340,000. So the goodwill will come to 41,250. It's good to Goodwill is the calculation. You just take the total investment, that is parents' consideration and NCI. You just deduct the fair value of net assets. Why? It's a transaction. What you give is the investment and what you get is the net assets. Why are you giving more? Because there's a goodwill. Okay? Okay, Dalamai, goodwill like 41,250. Goodwill like okay there. I will okay with the goodwill calculation. Can we move on to the other adjustments? Okay. Yes. Right. Can you explain again? Someone is asking. Lamai, now what is goodwill? Right. Goodwill is you have now when it comes to a business entity, the value of that business entity depends on their equity, right? Equity is what we are getting as the owners. Now, equity is what you are getting. Now, for an example, in this business, your equity value is 340,000. 340,000 is the equity value. Then, if you look at the total investors' value, investors are having a value of 381,000. Investors are having a value of 381,250. So, investors are giving an excess value for what? Investors are giving an excess value because there's an unrecognized asset in that subsidiary business, which is what we call the goodwill. For this goodwill, the owners are paying an excess figure, right? Excess value. That is what we consider as a goodwill. So the goodwill is basically the difference between investment and the net assets. What you pay more. Okay. If some Sanuke is asking, do I get the recording if my connection problem get burst? But you can check with the other co-hosts. They are the team from vLearning. You can check with them. Huh? Right. In the meantime, let us focus on. Let us do the remaining parts of the workings. Lamai. Let me put this to somewhere else. Otherwise, it will be difficult. Put it right below. Right. So let us start with the other workings on console PNL. Okay, look at the additional information. The first one says, during the year, Sigma PLC sold goods costing 5,000 to Beta with a profit margin of 10% on cost. This word is wrong, it should be markup. Right, make a margin can be happy, it should be a markup. But anyway, we'll work on the 10% on cost. Right. So we'll calculate the working number one, intercompany sales. Right. So as per the information given, it's a profit on cost of 10%. Right. So the cost of the items is 5,000. Right. Then the profit you are keeping is 10% of that. So the sales value is 5,500. Okay. Sales value 5,500. This is an intercompany sale. Intercompany sale. What is the double entry we are passing for an intercompany sale? Intercompany sales you cannot keep because when the parent is selling to the subsidiary, parent gets revenue, subsidiary gets purchase. So it's in vain. You are selling to yourself, your group, right? You are selling to yourself. That doesn't mean anything in a group account. So you need to net it off. You need to remove it. So debited to sales 5,500, credited to cost of sales 5,500. Now my intercompany sales and cost of sales shall be removed. That doesn't mean that the sale has not happened. Sale has happened, but individual company is okay. But in a console, the group accounts, it doesn't make any sense because parent and subsidiary together form a single entity. Then inside the group, when you're making a sale, it's like selling to yourself. So that you have to eliminate. Clear? Right. So we'll eliminate debited to sales. Now in profit or loss adjustment format, pretty easy. In P&L adjustments, let me give you the trick. All the income and expenses goes to the P&L that you know. And here the debits are minuses, debits are minuses, and the credits are pluses. That's easy. Why? Think about a debit. Income debit means income is coming down. When income comes down, profit comes down. Expense debit, expense goes up, so the profit comes down. So when the debits are there, the profit is coming down. Credit, income goes up, profit goes up. Expense credit, expense comes down, profit goes up. So the credits are pluses, debits are minuses. It's easy. So you'll apply debited to sales, credited to cost of sales. So I'm working number 1. Debited to sales, credited to cost of sales. Okay. Right. Let's move on to the next adjustment. Working number 2. Unrealized profit on inventory. So we need to be careful. Here the seller is payer. Seller payer. What is the meaning of unrealized profit? Now, when parent is selling, in this example, when the parent is selling to the subsidiary, parent is keeping a profit, no? Parent is keeping a profit and selling the items. If that item with the intercompany profit is sold to an outsider, then it's a realized profit because the intercompany profit is getting realized from money from an outsider. Because parent is selling an item, keeping a profit, and that profit included item has gone outside the group to an outside customer. The customer is paying for that intercompany profit as well. But if that profit included item within the group is still there, then if we are not eliminating, it might create a room for manipulation. Why? Because the parent can sell the items keeping, like a massive profit. Parent can recognize the profit. Subsidiaries assets are going up, so the financials can manipulate it. So we remove if there are any unrealized profits. Yeah, sales value is 5,500. You have put it correct, right? So parent sale value become the cost of sale to the subsidiary. Let's calculate the unrealized profit. We'll take the inventory figure. As per the information given, the remaining inventory is 1,100. It's pretty easy. The profit is profit on cost is 10%. That selling price equals cost plus profit. Here you are keeping the profit on cost now. So then if you take the cost would be 100, cost is 100, cost is 100, profit is 10, then obviously the selling price would be 110. And we are keeping the profit on cost, you are taking the cost as the basis. On top of that, you are keeping the profit. So accordingly, you can calculate the unrealized profit now. How? Unrealized profit is basically, let me give you the formula. The inventory, we need to divide by the unit selling price. And we need to multiply by the unit profit. So simply this 1,100 is the inventory, unit selling price is 110. We just calculated unit profit is 10. Right, so I'm getting the profit of 100 rupees. What is the logic here? inventory is a sale value to the seller. So once you divide it by the unit selling price, you get the quantity. Now 10,000 is the sale value. You are selling it at 1,000 rupees. How many items you have sold? 10. Per unit, what is the profit? 10 rupees. So 10 into 10, 100 rupees. Something like that. This is the unrealized profit. So this unrealized profit was kept by the seller parent. So then we need to remove that from the particular area, right? So we are going to remove that from the where that profit is isolated. Now we have already removed the intercompany sales. So once you remove the intercompany sales, profit will remain in cost of sale. So we have removed that from the cost of sale. Cost of sales will be debited 100, and we have removed that from the buyer's inventory. Credited to inventory 100. Debited to cost of sales, credited to inventory. Debited to cost of sales, credited to inventory. Debited to cost of sales. Let me debit. All the debits are minuses. Debited to cost of sales. Now you cannot put anything for the credited to inventory, because inventory is an asset, not an income or an expense. Okay. Right. We've done two workings here. We'll come to the second adjustment. 2 years ago, Beta PLC invested 5 million debentures issued by Sigma, which is matured in 5 years. The annual interest rate is 10%. Interest income of Beta PLC included the interest received for the year on debentures. Right? So we will try to remove that interest income, intercompany interest income. Working number 3, intercompany interest. So the debenture investment is 5 million. Interest rate is 10%. So the interest income so this we have to remove, debited to, because the intercompany income and expenses to the subsidiary company income, parent company and expense. That doesn't mean anything because these are intercompany, right? One company income, other company expense, both are in the same financial statement. Then we have to remove. Debited to interest income, credited to interest expense. Debited to interest income, credited to interest expense. Debited to interest income, credited to interest expense. Okay, right. So we'll remove those. Debited to interest income. This is working number 3. Here, from the interest income, we are going to remove 500. From the interest expense, credit means plus. So debited to interest income, credited to interest expense. Okay, right. Now මොනහරි වලට පැහැදිලි කරගන්න ලියා ගන්න ඕනේ නම් just let me know if you have anything to be cleared. If there's you need time, anything, just let me know. Let's move on to the next item. Third one, Sigma PLC has occupied the stores belong to Beta from 1st April and an annual rent of 50 was paid. It's pretty easy. Bucket number 4, intercompany rent. The intercompany rent is 50. Now we just have to remove that. Debited to rent income 50. Credited to rent expense. Because intercompany income and expenses we cannot keep, that will overstate the financials. Debited to income, credited to rent expense. Debited to rent income, working number 4, debited to rent income. Here the other income. Debited, credited to rent expense. This is an admin expense, no? Credited, sorry. So what we did was we removed from the income, credited, sorry, credit should be plus. We remove that from the income and the expenses. Right. Okay. Last item. On 1st of April 2023, Beta PLC sold a machine to Sigma for 5 million. Machine had a carrying value of 4 million. Useful life is 10 years. So working number 5, first of all, we need to deal with the unrealized profit on PPE. Seller is subsidiary. Seller subsidiary. So the sale proceed was 5,000 and the carrying value was 4,000. So the disposal gain was 1,000, which is an unrealized profit. So we need to remove the unrealized profit. We need to remove the unrealized profit, right? We need to remove the unrealized profit. So that is inside the other income, not debited to other income. Credited to property, plant and equipment. Because of this unrealized profit, when you are selling to one of your group entities with a profit, the seller would recognize an income, the buyer would recognize the PP increase. End of the day, it's an intercompany transaction which is not realized. Right? Realized in the sense not an outsider is going to pay for this. Right? Now here we need to be a little careful. This other income, let me highlight in different color as well. Because this is going to impact the NCI. I'll tell what is that. Right, first of all, we'll deal with the transaction. Debited to other income, adjustment number 5. Debited to other income minus 1,000. And credited to PP. So you cannot do anything with the PP. Debited to other income. PP is in the balance sheet in financial position. So we are not going to pass any adjustment for that. Right. Now that we are going to factor when we are calculating the profit attributable to NCI. Right. Let me put a small star mark here. This profit attributable to NCI, I'll have to consider this one. This 1000 will have to factor. I'll tell when we do that part. Right. Okay. Then because why someone would ask why is not any other adjustment, why it is impacting? Because seller is subsidiary. Subsidiary has kept a profit, and this is not an intercompany income or expense. This is a pure profit. So one side it's in the other income, other side in a balance sheet item. So this will actually definitely change the profit. You can clearly see these other items will not change the profit. Minus 500 plus 500, minus 50 plus 50, minus will not change the profit. Right. So here we comes to the last adjustment, working number 6. Depreciation on URP. This is done by the buyer parent. So if it is parent, there's not to worry, it will not impact the NCI profit. Now the unrealized profit is 1000, and the useful life is 10 years now. Then the period used is 1 year now, right? This transaction has happened on the 1st of April, so for 1 year. So that means you have done an over depreciation. So the over depreciation is 100 rupees. So you have done a parent company being the buyer has done an over depreciation of 100 rupees. Parent company, the buyer has done an over depreciation of 100 rupees. Remember guys, we are talking about a machine. So obviously it may be an admin cost. So we are trying to remove an over depreciation. Then, the definitely debited to accumulated depreciation. 100 credited to administration depreciation expense, which is in the admin expense. Okay. So how did we get the over depreciation? Now look here. Really speaking, the value of this asset is 4,000, but it has been sold at 5,000. So through the buyer, 4,000 worth of asset was received at 5,000. So he's depreciating the 5,000. So he's excessively overly depreciating 1,000. Right now, subsidiary when selling the PP item to the parent has kept a profit. No, the buyer is depreciating for that profit as well. So it's over depreciation. Are we clear? Right. Okay, so we just have to credit the depreciation expense to the admin. Admin expenses will be here. I'm going to credit. Credit means plus. Right. Okay. And that's it. Now we can take the line by line additions. Okay. Sales 250 and 150,000. 250,000 plus 150,000 plus this. The tricky point is, Lamai, when you're taking the line by line addition, take the minuses as minuses, pluses as pluses. Cost of sale 150,000 minus 90,000 plus 5,500. So you'll get the gross profit of 159,900. We'll take the other income 1,200 plus 950 plus 500 plus means minus. Dividend income 500. There's nothing now regarding this dividend income. There's no other information, so that we'll think that it's coming from some other. We don't know. It's coming from the subsidiary. We don't know. So the other income 150 plus 1 250 minus 50 minus 1000. Distribution expense minus 12,000 minus 7,000. That means 60 and 46. Minus 6,000 minus 46,000 plus 50 plus 100. Finance expenses minus 6,000 minus 4,000 plus 1. So you will arrive at a profit before tax of 20,050. Let's take the tax. 6,500 minus 1,550. 1,000. So you'll get a profit after tax of 8,050. Other comprehensive income is 0. So the total comprehensive income is also 20,000. So completed. Only thing is we need to allocate the profit to NCI and to the parent. So let me show this calculation. It's very easy. Profit attributable to NCI. I'll show it here. I just have to take the subsidiary profit. How much is the subsidiary profit? Here you can see subsidiary's profit for the year is 3,650. Let's get that figure. 3,650. From that, make an adjustment for whatever the items which will impact the subsidiary profit. There's only one item here. This URP on PP. Generally, the items which can impact the subsidiary profit are only three. What are the three? Net unrealized profit if subsidiary is a seller. Unrealized profit if subsidiary is a seller. Depreciation if subsidiary is a buyer. And goodwill impairment if the NCI measured at fair value. There's only three items which can change the profit of subsidiary. Right? What are the three items? Unrealized profits if subsidiary is the seller. Unrealized profits if subsidiary is the seller. Depreciation if subsidiary is the buyer. And goodwill impairment if goodwill measured at fair value of NCI. So there's only one item. So minus 1,000 here. And from that, you just have to take your percentage. Please. So let me take 3,650 minus 1,000. From that, take 25%. 660. That's it. Now you can take the difference to the parent. 20,000 minus 660. It's calculated in such a way 20,000 minus 660. Right. So the same two answers will apply here. Okay. This is basically the answer for the console question. Can you show the workings? Working number 1, intercompany sales. Working number 2, unrealized profits on inventory. Working number 3, intercompany interest. And working number 4, rent. Working number 5, unrealized profit on PP. Finally, depreciation on URP. Okay. Right. Okay. Amai, so we have completed the question. It's your call. Right. What is the next question required? So we got altogether like 40 minutes. Company. Okay. So all in all, everyone are requesting to do the company question. This is question number 9. So it should be question number 10. Yes. Right. Okay. So we have a company question. Right. Okay, let's do the company question. Look at the requirement. Following financial statements of Sumedha, you have to prepare the P&L, statement of changes in equity, and the statement of financial position. Okay. So we'll start from the beginning. So Sumedha is a stationary trading company which is registered for VAT as well. You got the salary, the rent, electricity, telephone purchase, VAT payments, PP opening balance, inventory opening balance, cash tax paid for the year. Then we have the sales, VAT collections, retained earnings, opening balance, revaluation reserve, lease creditor. Why please change this lease creditor to a loan? Right? Can you please change this to a loan? Okay, ටියුට් එක loan කියලා හදාගන්න. It should be a loan balance. Oh, sorry for that. Loan. It's not a lease creditor, it should be a loan. Right? General reserve, accumulated depreciation. Right. Before preparing the financial statements, following. Commission 2% paid for the agents included in salaries. Electricity bill 15,000 March 2024 not yet paid. 18,000 paid in advance telephone charges. However, the bill for the month was 8,000. Right. Inventory item by item is specifying on the date the net realizable value cost. So this one NRV is higher. NRV is higher. This one NRV is lower. Data 750 bankrupt. Composition of PPE, motor vehicles, office equipment, furniture. Assets have acquired. Assets have been acquired on 1st of April 2022. Useful life 5 years. On 1st April 2023, remaining useful life of furniture was revised as 6 years. Office equipment got revalued 31st of March for rupees 1,008. Issued 40,000 ordinary shares at 20, capitalizing general reserve. Tax 500. Right. So we are going to draft the statements. This is question number 8. Ne? I will start drafting the statements. This is Sumedha PLC, right? Yes. Sumedha PLC statement of profit or loss for the year ended 31st of March 2024, rupees thousands. Sales, cost of sales, gross profit, other income, distribution expenses, administration expenses, other expenses, finance expenses, profit before tax, tax, profit after tax, other comprehensive income, revaluation, total comprehensive income. We got notes for the other income. Profit before tax and tax. So the PLC statement of comprehensive statement of changes in equity. I have the stated capital, evaluation reserve, general reserve, and retained earnings. Opening balance, reserve capitalization, total comprehensive income, closing balance, Inventory trade receivables, prepayments, cash equivalents, total assets. Okay, then under the equity, we have stated capital, revaluation reserve, general reserve, and retained earnings. We need some space. We have the non-current liabilities. We have the bank loan. Then we have the current liabilities. Trade payables, tax payables, other debts. Other payables, we'll have a note number 5. These are the main 3 statements. If you're okay about the 3 statements, just let me know so that I can draft the remaining notes. ළමයි ස්ටේට්මන්ට්ස් ටික 3 දාගත්තා නම් මට ඕකේ කියන්නේ. Are you okay with the statements? Okay. Like I told you, put these formats into a piece of paper. Company, cash flow, defer tax. In case there's a question on borrowing cost, there are several formats we use, then it will be much easier, right? So let me draft now I have the three statements here. Let me draft uh, say the other notes. So let me start with the notes. Note number 1 is other income. Note number 2 is profit before tax. Note number 3 is taxation. Note number 4 is the PP note. Let me take the note number 4 here. Property, plant and equipment. Start to the cost with the valuation. Here the motor vehicle. Office equipment and furniture and fittings. Office equipment, furniture and fittings, and the total. Here the opening balance, additions, disposals, transfer of accumulated depreciation, revaluation, closing balance. Then the accumulated depreciation, depreciation for the year, disposals, closing balance. Finally, you'll get the net book value. Right. Then note number 5 is about other payables. Right. Then we need to have the expense statement. We have cost of sales, distribution expenses, admin expenses, other expenses, finance expenses, Actually, okay, we can start with the workings. 3 workings. Everything is ready with the format. We are ready, we can start. Right. So one student has confirmed that they are ready. Others, please drop me a message saying that you're okay to proceed. Others, are you all okay? Oh, right. Super. Good, 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 good. So can you tell me the deferred tax? Right. So our student is asking about the deferred tax. Right. I don't know whether once we do the company accounts, we will have time. Time permits. Let's me do the deferred tax as well. Deferred tax is not a difficult one. It's easy, right? But now we have just started this question. We'll try to complete this first. Right. We will start with the workings. Okay, the first one is what they're saying is commission of 2% paid on sales to the trade agents has been included in salaries. Whatever the commission you are paying to the trade agents is a distribution cost, not an admin cost, right? So we'll calculate that and we'll transfer. So you can see the sales value is 12,000. Currently we'll start the working number one, agent commission. Right. So the sales value is, as per the information given, sales value is 12,000. Then the agent commission at 2% is 240. Now, you're not supposed to write the double entries. You don't have to write the double entries, but for your reference purpose only, I'll give the double entries. You don't have to write. Huh? Debited to uh, agent commission expense and credited to salaries. Debited to agent commission expense, credited to salaries. You don't have to write the double entry. Yeah? Right. Shall we pass the entry? Debited to agent commission expense, credited to salary. Here is my expense statement. Agent commission. Debited to distribution, I'm adding that to distribution. And remove that from the salary. If you can put this plus minus, that will be enough. Debited to agent commission, credited to salary. And I have to update that in the salary cost here because this is profit before tax is not a you know particular kind of an adjustment type of thing. It's just a disclosure. So I have to present the salary expense. Salaries, it should be minus 240. Why? Because we have to remove that. No. So when we are getting the salary cost, I will update that. Yeah. We'll come to the next one, working number two. Electricity bill 15,000 has not yet been paid. CC accrued electricity. It's 15. No, you don't have to write double entry. I'm just giving for your reference. So debited to electricity expense 15, credited to accrued electricity. Electricity is you have consumed. No, that's an expense. No. Only thing is you haven't paid yet. You have consumed, but you haven't paid. Right. So let me update this one. No? Debited to electricity expense, accrued electricity here, electricity. Debited to electricity expense 15. Credited to accrued electricity. On the under other payables, we have the accrued electricity. The note. Let me update that 15. So I added 15 to electricity and to the accrued expenses. Okay, right. We'll go to the next one, working number 3. We have the next item says 18,000 of the telephone charges has been paid in advance, but the bill was only 8,000. Telephone prepaid. See, paid 18,000, but the bill amount is only 8. Right, so the prepayment is 10. So we'll pass double entry debited to telephone expense. Sorry, we have to recognize that as prepayment. Debited to prepayments 10. Credited to telephone expense. Debited to prepayments, credited to telephone expense. So we'll recognize that in the prepayments. Okay. I'm adding that to the prepayment 10 rupees. Crediting to the telephone expense. Yeah. It's an admin expense. I have to remove that from the expense. Minus 10. Okay. Right. So you're done like 3 workings. Next one is on inventory. I mean, you can clearly see in this question, they are giving the purchases and the opening inventory. That means they haven't adjusted the closing inventory. In this question, you have the purchases and the opening inventory. So you have to adjust the closing inventory. So working number 4, closing inventory. So if you look at the closing inventory cost here, cost of the closing inventory items is 520, 320, and 280. Let me put that. Item A, 520, item B, 320, item C, 580, so 280. So the total cost will come to 1180. 1180 is the total cost. What is the double entry? Debited to closing, debited to inventory, credited to cost of sales. Debited to inventory, credited to cost of sale. That entry they haven't passed, so we have to pass it. Debited to inventory, credited to cost of sales. So pass debited to inventory. Here I'm just putting that as plus 120 because there will be an NRV adjustment, net realizable value related adjustment, plus 120, credited to cost of sales. Closing inventory, credited to cost of sales. So debited to inventory, credited to cost of sales. Okay. What else are there? Yes, NRV loss. So this is going to be my working number 5. NRV loss, net realizable value loss. Regarding item B. Item B cost is 320, but B's net realizable value is 250. So the NRV loss is 70. So we pass double entry debited to NRV loss expense, which is another expense. 70 credited to NRV loss provision, which will be reduced from inventory. NRV loss provision will be reduced from the inventory. NRV loss expense goes to other expenses. What is the meaning of NRV loss? Now you have incurred a cost of 320 to produce an asset, produce an inventory, but you can sell it at 250. So you are at a loss, no? That you have to recognize. It's an estimated loss, so you have to make a provision. So we can't do the total. In this question, the question clearly says company values inventory on item by item basis. Right? So we have to take this separately. Right. So we'll recognize the NRV loss to the other expenses, 70. And we have to deduct that from the inventory, credited to inventory, yeah, minus 70. Okay. So you've done up to like 5 workings now. Let's see what are the other adjustments remaining. A debtor with a balance of 750 has gone bankrupt. It's very easy. Okay, number 6, bad debt. 750 debited to bad debt. 750 credited to debtor. 750 debited to bad debt, credited to debtor. 750. So debited to bad debt, which is a distribution expense. 750 debited to distribution expense, credited to debtor. So trade receivable front of that minus 750. Okay, right. Then we need to do the PP. We have all the opening balances. We have the opening balances that we will update to our PP note. Motor vehicle opening balance is 6,000. Office equipment 2,500. Furniture and fittings 1,500. Right. Then the accumulated depreciation opening balance 2,400, 1,600. 2,400, 1,600. Right. We just updated the recall the opening balances, right? Okay, we'll look at the rest of the adjustments there. I've just updated the opening balances. Look at the next items. This all assets have been acquired on 1st of April 2022 on this date. Their useful life was estimated as 5 years. They're depreciated on a straight line method. Then they're saying on 1st of April 2023, the remaining useful life of furniture was revised as 6 years. Further, the office equipment was revalued at a market value of 30,800 on 31st of March. First of all, we'll do the depreciation. This question is okay. We can just go ahead with the depreciation. So working number 7, depreciation. So the items include motor vehicle, office equipment, and the furniture. Right? Okay. So you know the balances. You take the balance. We just updated now. Motor vehicle 6,025 and 15. 6,025 and 15. Only thing is, Ramai, in this furniture, they have revised the useful life. So that we have to take the depreciable value only for furniture. So I'm deducting the accumulated depreciation or the opening accumulated depreciation. only for furniture, just to get the depreciable value. So the furniture is 600. So now I'll be getting the values. 6,000, 2,500, and right. So we'll apply the useful life generally for others. Only for furniture, I'll apply the remaining useful life. This one was 5 years, 5 years. This one is 6 years. So why are we doing this one? Ramai, now the question clearly says furniture and fittings, they have revised the useful life. No? So when it is revised, you have a remaining useful life. Now, motor vehicle and office equipment, you have a general useful life. But the furniture, it's a remaining useful life. So the remaining useful life, you have to apply to depreciate the remaining depreciable value. Now, 1,500 is the cost of the furniture. 600 is already depreciated. No? Remaining depreciable value of 900 shall be depreciated over the period of 6 years. Others are okay. So you can calculate the depreciation. Here 6,000 divided by 5. 500 and 150. Thousand 200, 500 and 100. So we'll update the double entry, debited to depreciation expense, credited to accumulated depreciation. So we'll take the items. First one is the motor vehicle depreciation. Then we have office equipment and the furniture and fittings. Motor vehicle depreciation goes to distribution expense, 1,002. Office equipment and the furniture goes to admin, 500, 150. Debited to depreciation expense, credited to accumulated depreciation. So I'm opening balance. So for that. So depreciation for the year, motor vehicle is 1,002. Office equipment is 500. Sun is 150. Debited to depreciation expense, credited to accumulated depreciation. Only thing was there was an asset which has revised the useful life, so that I have to take the remaining depreciable value. Remaining depreciable value. In the meantime, until you take down, I'll update the PBT note. We had an NRV loss, which should be presented separately. We had a bad debt, 750, and the depreciation in total, 1,850. This is just a presentation. Profit before tax is just a presentation, but you are getting marks. You need to put some critical expenses, some critical expenditure here. That's it. Once you put some critical expenditure, you are getting marks. It won't get added and connected to any other place, right? Okay. So we are done with the depreciation adjustment. Easy one. So working number 8, let me deal with the revaluation. Now, if you take the revaluation, you are doing the revaluation on the very last day. So if you take the revaluation of furniture here, sorry, office equipment, if you take the cost of the office equipment, it came to a value of 2,500. Okay. And from that, we need to deduct the accumulated depreciation. How much is that? Accumulated depreciation, you had an opening balance here of 1,000, and the current year, because you are doing the revaluation, you are doing on the last day only. You're doing the revaluation on the very last day. So you have to take the current year depreciation. So the current year depreciation came to a value of 500. So the accumulated depreciation is 1,005. So net book value of the asset is 1,000. The net book value. Now, for you to get the net book value, you need to net off the accumulated depreciation. That is the first double entry. Debited to office equipment accumulated depreciation, which is 1,005, credited to office equipment. Debited to office equipment accumulated depreciation, credited to office equipment. That is the first entry in a revaluation. When you are revaluing, first of all, you need to net off the depreciation. You have to net off the depreciation. Okay. Right. Shall we pass that entry? This is what? This transfer of accumulated depreciation. Debited to accumulated depreciation. Sorry, this one. Debited to accumulated depreciation. Credited to office equipment. So you can see the depreciation was removed. Now the depreciation will become 0 and it was netted off against the asset. So you can get the net book value here, 1,000. Then the next step is the revaluation gain or the loss. Now the revalued amount, as per the question, it's 1,800. No? Question clearly says 1,800. You are going to compare it with the net book value, which is, we just calculated 1,000. So you are at a revaluation gain of 800. You are at a revaluation gain of 8. The question is, whenever you have a revaluation gain, you need to check whether there are any revaluation losses from a previous year. Why? Whenever there's a gain, first of all, you need to net off the prior year gains to that prior losses. To that extent of loss, the portion of the gain will be recognized in P&L. Because earlier there was a loss. Loss was in P&L. No? Now, when you are making a gain, first of all, you need to remove that loss. So that gain will be passed to P&L. The net gain, after deducting that loss, the net gain will be recognized in the reserve. Here we have a revaluation gain. The question is, do we have a prior year revaluation loss? The answer to that question is no, because we have a revaluation reserve already from the office equipment. 600 reserve is there now. That means previous years we don't have a loss, we have a gain. Right? In the previous years we have a gain, not a loss. Right? So we can easily recognize this in the revaluation reserve. Debited to office equipment, credited to revaluation reserve through OCI. Debited to office equipment, credited to revaluation reserve through OCI. right? Still pass the entry. Debited to office equipment here. Revaluation 800. Debited to revaluation 800. Credited to OCI. Here we have revaluation in the PNL 800. Go to the PNL, go to the revaluation, put 800. Okay. So we have completed working number 8 as well. Working number 9. They're talking about reserve capitalization, right? 40,000 ordinary shares at 20. So we'll work on the reserve capitalization. Shares 40,000 means 40. Price per share, as per the question, is 20, right? 40,000 issues, shares issued at 20 per share. That is a bonus issue. In other words, reserve capitalization is a bonus issue. So the value of the bonus issue is 40 into 20, 800. Pretty easy. So the double entry, you are capitalizing the reserve, debited to general reserve, 800, credited to stated capital, 800. Debited to general reserve, credited to stated capital, 800. Debited to general reserve, credited to stated capital. Right. We'll pass that here. Reserve capitalization, debited to general reserve. From the general reserve, I'm going to deduct 800. And I'm going to add the same to the stated capital. Remove that from the general reserve, add that to the stated capital. Okay. Right. Easy. Last one, working number 10, is about the tax. It says the current year tax is 500. Let's look at how much you have paid. Tax paid 535. That means you have paid an excess value. Ne? Shall we work on that? So the tax expense is 500, but the tax paid is 535. So the tax overpayment is 35. So how to put this into a double entry? So debited to tax expense, my tax expense should be 500. And the overpayment is a tax receivable. Debited to tax receivable, you have done an overpayment. There is going to be an asset for you because you can recover that from a future tax. Credited to tax paid. So in your trial balance, the tax paid will be removed. Tax paid the trial balance here. This one will be removed. Minus 535. So this will become 0. Right? Tax paid removed. It should be debited to tax expense, debited to tax receivable. We are removing the tax paid amount in the trial balance. We recognize that 500 in the tax expense, 35 in the tax receivable. Let's work on. Here we have the tax. We have the current year tax, which is going to be 500. Current year tax. And the tax receivable is going to be 35. So we put that to the tax expense and the tax receivable. Tax expense and the tax receivable. Okay. Right, so we have completed all the adjustments. Now it's matter of taking the line by line additions. Salary is 1000. Salary is an expense. Let's record it here. Salary 1000. I'll add that to the admin. I have to update here. 1000 minus 240. Sorry. Salary 1000. Rent 540. Electricity 120. Telephone 75. Purchases, that goes to the cost of sales 6000. VAT payment. Now my VAT payment is going to be recorded in a VAT control account. That is under another payable. VAT control. All the paid VAT is going to be an asset. So my liability would come down. VAT payment would reduce my VAT liability, minus 600. VAT payment would reduce the VAT liability. Because your paid VAT you can recover. No? PP done, opening inventory 1200. That is part of my cost of sale. Right? Trade receivables 7000. Let's update that in the financial position. 7000 minus 750. 6250. Let me update the inventory as well. 1000. So I have updated up to trade receivable. You just have to pick the items from the trial balance and put it in the correct place. That's an easy task. Cash at bank 730. Cash at bank 730. Sales 12,000. VAT collection. When you're collecting the VAT, you have to pay that back to the government. So VAT collection is going to be a liability. So it is going to be minus 600 plus 130. Whatever the VAT collected, you have to give it back to the government. Stated capital 4,000, 2327 is the retained earnings. Stated capital is 4,000. Retained earnings 2327. Revaluation reserve 600. Loan balance 2353. I told you the bank loan 2353. Loan balance 2353. General reserve 1200. Accumulated depreciation we took. Right. So Lamai, we have taken all the items from the trial balance. So we need to just close our notes. Let's see. The zero in other income. Profit before tax is not a, we don't have to take the total, nothing, right? We just keep it as it is. Tax is 500. Tax is an expense. Tax is minus 500. Other payables total is 735. Other payables total is 735. Let me take that. Other payables 735. PP 4950. Property, plant and equipment, I have taken the total 4950. 4950. 4900. I just have to take the expense total. Yeah. Cost of sale minus 6080. Distribution expenses minus 2190. Admin 2150. Fine. Other expenses 70. Finance expense is 0. Right. So we have closed down the T accounts. We just matter of closing our statements. Your gross profit is 5920. Your profit before tax is going to be 1510. So your profit after tax is going to be 1010. Your total comprehensive income is 1810. Revaluation was 800. Profit after tax was 1010. Stated capital 4800. Revaluation reserve 1400. General reserve 400. Retained earnings 233337. Right. So the total here comes to this figure. Liability is no trade payable, only another payable. So the total will come to a figure of 13,025. My PP 4950. My current assets 8,075. So the balance sheet gets tallied at 13,025. Okay. PP note. Yeah. Okay, Lamai. Right. So we have done three part C questions. The cash flow statement we have done. and we did the cash flow consolidation as you all requested. Then we did the company question as well. Right, time is over. We have taken extra half an hour. But on the request only, let me try to do the deferred tax. Right. Okay, but I won't be. We'll try to do it as soon as possible. The deferred tax question, which is not a difficult one. Right. Let's try to do the deferred tax, which is question number 7. Deferred tax. Right. Now, my deferred tax is not a difficult thing. The deferred tax is about you calculate the future tax and you make a provision. You calculate the future tax. You calculate the future taxable profit. Now here in this question, if you look at what are they asking? They are asking you to calculate the deferred tax. Okay. Calculate the deferred tax asset or the liability as at the year end. Then they have given you certain information, details of non-current assets. They have given you the cost, the land and the plant and the equipment is given. And they have given you the accounting carrying value, right? Accounting carrying value of the land, right? And the cumulative depreciation for the tax purpose is given. So the accounting carrying value, written down value as at 31st of March is given as 32.5 here. Cumulative depreciation for the capital allowance tax purpose is 16.3. The provision for gratuity is given to you, which is 12 million. Opening deferred tax liability was 810,000. They are paying the taxes on 14% per annum. First of all, what we are trying to do is we are trying to replicate the future tax calculation, right? So now here we have 3 items. What are the 3 items? One is land, other one is the land, other one is the plant and machinery. The third one is the gratuity. These are the 3 items. The total. First of all, what we need to understand is unless otherwise stated, lands are not taxable. No, land we don't depreciate. Land sale. If the question specifically says land disposal capital gains are taxable, we have to take. But in general, lands we don't take, right? So lands, the capital gains are not taxable up until a recent year. No. So land in the question, even they are saying it's not. They haven't mentioned anything, right? So land value is 10,000. Accounting carrying value, they haven't put anything there. Cumulative depreciation for the tax purpose, right? So we don't know whether the land is taxable or not. So I'm just taking an assumption here. Otherwise, they should have given land is considered as not taxable. So we won't be taking the land component, right? But we will take the rest of the components, right? So here in the future taxable profit calculation, we are comparing the accounting carrying value, which is the future depreciation, versus the tax base, right? Okay. So I'm just trying to fix some workings. Accounting carrying values are given. Land I'm not taking. Accounting carrying value is given here, which is 32.5. Gratuity is a liability, no? This is a liability. And so I'll put that as minus. Accounting carrying value minus. Because since it's a liability. Okay. in the tax base. How do we calculate? Let me put some workings. Working number 1, tax base of plant and machinery. We'll take the cost of the asset, which is 40,000. In the question, it clearly says 40,000. And from that, we need to just deduct the cumulative capital loss. That is also given in the question 16,300. Now, here the tax base of a PP is the future capital allowance. Already you have claimed 16,300. Remaining is your future capital allowance. What is the accounting carrying value? Costless accumulated depreciation. What is that? That is your future depreciation. So simply you are replicating the taxable profit calculation. You are adding back depreciation, deducting capital allowance. Deduct the capital allowance. You're deducting the future capital allowance. So from the accounting carrying value, you deducted the tax base. We'll take for the gratuity as well. Working number 2, tax base of gratuity. As well, case 2, tax base of gratuity is the carrying value, which is 12,000, minus amount deductible for tax when liability gets settled. Amount deductible for tax when the liability gets settled. Now when it comes to the gratuity, right? Now your existing liability is 12,000. When that liability is getting settled, that means you have been paying entire thing, you can deduct for the taxation. So the tax base will be 0. For a gratuity, your existing provision, when you're paying, you can claim that, you can deduct that from the tax. So gratuity, it's going to be your carrying value is the same carrying value. You can deduct from the taxable profit calculation. So the tax base will be 0. So thus now you can calculate the temporary difference. You can calculate the temporary difference, right? Here, your temporary difference. So this one is a taxable one, but this one is deductible. So overall, we are at a deductible. Why we say deductible? When you get a plus answer, that means future you are going to have a taxable profit. So you're going to pay taxes on it. But when you get minus, that indicates in the future you are going to pay lower taxes. You are going to pay lower taxes in the future. Right? So overall, you are going to pay lower taxes in the future. And apply the tax rate, which is 14%. Right? And calculate the closing deferred tax liability. So here the closing deferred tax asset, because it's a deductible one. So your closing deferred tax asset is 448. Let me put it to even a balance sheet here. Sorry, T account. Right. Now opening your deferred tax, you have a liability, right? Opening, you have a deferred tax liability in the question. Opening deferred tax liability is 810. Now let me put it here. Let me put deferred tax liability, which can be the asset. Opening, you have a liability. Opening balance, you have 810. Okay. And what they are saying is, Lamai, your closing balance is going to be an asset. Closing balance is going to be an asset. So then going forward, your next year opening balance is going to be an asset, no? Which is 448. So closing balance should come from this side. So that means in the current year, you have a deferred tax reversal. Deferred tax reversal, which is your deferred tax. Earlier you had a liability which is going to become an asset. So the double entry, when I'll put the double entry, right, the difference here will come to this total name. Altogether 1258. The double entry will be the deferred tax reversal, the double entry. Debited to deferred tax liability. Your deferred tax liability will be debited 1258, credited to deferred tax expense. Your deferred tax expense would come down, right? So your deferred tax expense would come down. The deferred tax expense would come down by 1258. The difference here may take away an asset. 1258 because asset is becoming a liability, right? So the final answer, the deferred tax reversal, it's not an expense, it's a reversal. It's going to be 1258. Okay. So deferred tax is simply you're replicating the future taxable profit calculation. So when it comes to a PP item, you add back the future depreciation, which is accounting carrying value. You deduct the future capital allowance, that is costless accumulated capital allowances already claimed. If the difference is plus, in the future you are going to have a profit. If the difference is minus, you are going to have a loss. For a gratuity or such type of a liability, the carrying value is the liability. Now we take it as minus because we have to take the net figure. Tax base is generally going to be 0 because your carrying value you are going to deduct when it's getting paid the taxable. So ultimately get the answer whether it is taxable or deductible, apply the tax rate, calculate the closing deferred tax asset or the liability. If it is deductible, it's asset. If it is taxable, it's a liability. Then compare with the opening balance. For the difference, you need to pass a double entry. Okay. Right. Right. Okay, Lamai. We have done several set of questions, cash flow, company, console, deferred tax. The target time was 2 hours, but we took extra 45 minutes. And thank you for joining and staying with us, right? And your support is really, really important. And yeah, they are in the WhatsApp group. If you have any questions, you can ask. And please feel free to send a comment, feedback. This is a feedback form, right? Please feel free to send and please join with vLearning because a lot of model questions, areas we have covered, and you can refer the content. And with the vLearning, this is the third model paper I'm doing. So you can refer the earlier papers, right? So I hope you had a good learning. You got something, right? And on behalf of JMC Virtual Learning, as your county lecturer, I wish you all the best in the upcoming exams. Make sure you give your best. Okay, right? So let's wind up the today's session. Good. Right. Thank you, Ramai. Thank you for joining. Okay. Thank you. Thank you. I'm in the